Good afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer webcast. Joining me today is David Burrows, our Chief Investment Strategist and Portfolio Manager at Barometer Capital. And Dave has a lot to cover this afternoon, so let's be quick and we will turn the conversation over to Dave. We're happy to address questions at the tail end of this call, so don't be shy. Email me at phastings@barometercapital.ca or hit me up on the Zoom link via the question and answer queue. And with that, David, I'm turning it over to you. Happy afternoon. Look forward to hearing what you have to say in this interesting market.
Thanks, Pam. Thanks, everybody, for joining today. Yeah, we do have a lot I want to go through, so I'll try and move a bit quick today. Certainly, markets continue to unfold in front of us. And as always, we want to ask the question, are we positioned properly thematically? Are the positions working? What is it that's changing? Because at the end of the day, we don't have to be everywhere. Our job is to target areas of the market that can be revalued, where we're going to get some yield, where we're going to get some multiple expansion, and between the two, generate some total return with some diversification. So just from a high level, we continue to be in a structural bull market in equities. Started in 2013 in the US. It certainly has broadened out to other markets over the last number of months. But in a bull market, you kind of get 3 steps forward, 1 step back. We recently had some corrective period at the end of December through about the 3rd week of January, which looks to have resolved and resolved higher. We'll examine that a little bit. But certainly the hardest thing in a bull market is to stay in your winning positions. When themes start to work, it tends to go on for a long time. And just like when themes go out of favor, they can go out of favor for a long time. We also think we've been going through a structural bottoming in interest rates. We got to a point in March of 2020 where there were billions and billions and billions of dollars of negative yielding government bonds around the world. And we'll take a look at that as it relates to some of the changes we've been seeing in rates. Our view has been that we saw generational low in yields in March of 2020 at 60 basis points. And since then, the 10-year bond yield worked its way higher through the course of 2020 and early 2021 to about 175 basis points or 1.75% the 10-year US Treasury bond. We then took a pause, and through the course of the spring, summer, we dealt with Delta and the oncoming Omicron virus. But you can see clearly that in the end of December, we broke those highs in yields from April of last year. We made the case that we were starting the next leg of reflation, which would be part reopening, part inflation, but the inflation of the value of assets. And it looks to be the case. Certainly yields on the 10-year now are pushing just about 2%, 1.96%. When we look around the world, it's happening in other places. Who would have believed that the most negative yielding bond market, the most negative bond market for a long time from a yield perspective, would go through this kind of bottoming. 2016, the JGBs were yielding minus 0.3 of 1%. We revisited those levels again in 2019 and again in 2020 at a higher level in the COVID low. That should have been a tell. Usually when you're bottoming in a long-term pattern, you would have a higher low. Of course, we had a higher low in the COVID bottom. And now 10-year yields for Japanese bonds are plus 20 basis points. That's a major change. It's also a major change what we're seeing in Germany. We've gone through a bottoming process there as well in 2019-20. Yields got to just about minus 80 basis points, now positive, sort of 25 basis points. So yields are working their way higher around the world. Certainly in the US, the 2-year yield since September of 2021, so only a few months ago, have moved from 0.2 of 1% to 1.33 as of about 2 o'clock this afternoon. Yield in the 5-year has moved from in September about 80 basis points to 181 basis points. So we've seen a shift in yields across the curve moving higher, which of course is a big deal. The percentage of global debt that was trading with negative yields started to come down through 2021, but over the last 2 months really has cratered by about 65%, meaning yields are moving up everywhere. And it may well be that the era of very easy money and quantitative easing is over. The Fed has been signaling that. Our view has been we've been going through a generational shift in yields. And certainly when we look at an aggregate index of issuers and maturities, the bond market is in difficulty. We clearly are in a bond bear market. If you take the aggregate bond index since September of 2020, you've had a quite significant decline. But even just in the last month, the aggregate bond index is down 4.2%, and that would include lots of very short-term bonds as well. The 10-year and the 30-year bond down much more than that. Our view has been stay clear of bonds, that the yield being paid is not nearly enough to compensate for the risk that you take of a falling bond price. In our macro strategy, we've been short bonds now for the last 18 months, quite significantly. And so that regime change looks to be continuing. We talked about the fact that we were going through a bottoming in commodity prices, certainly relative to other assets. You know, when we look at the way we construct portfolios, first of all, it's our job to understand which asset classes are constructive, which ones we should be focusing our attention in to be long, and that when revaluation starts, it can go on a long time. So bull market stocks in the US went on from 1981 to 2018, 19 years. We've been in a bull market now since 2013. We've been in a bond bear market really since the mid 1980s, with an interruption in the early part of this century. And here we are, we got to a point by 2020 that the 10-year compounded returns for a basket of commodities was about sort of minus 9% per year. We moved up through that zero line. And our base case is that this could go on for several years until ultimately, probably you wind up with 10-year annualized returns in the teens. And that really has only just begun. So this is the aggregate index of commodities, an equally weighted basket, which was down 77% during the most recent leg of the bear market, turning higher. You can see that on a relative basis, relative to stocks, for the first time in many years, over the last 18 months, you've seen rising relative performance of commodities versus the S&P 500. In other words, it has been outperforming now for about 16 months. And certainly there was a pause through the course of this past summer and a little pullback into the end of November. So really from April to November, that was a consolidation. And we started the next leg higher in November, December. And of course, it's continued through January. When we look at the S&P 500, the S&P 500 corrected about 12.4% from the beginning of January, made a low, retested the low a couple of times and worked its way higher. We're now back above the 200-day moving average. So S&P is acting constructively, even though it did have a correction. A correction is totally normal. When we look at the Nasdaq 100, I've used a different chart package just to show relative price performance versus the S&P. You can see that since November, relative price performance versus the S&P has been falling fairly steadily. And certainly we got to bounce off those lows in January, but unable so far to retake that 200-day moving average, and unable really to make any gains versus the S&P on that bounce. I've always said when you have a correction, at the end, almost everything will be impacted. What will be important to see is what rallies first, and then on the first pullback, what holds and what doesn't. And you can see that the NASDAQ 100 really did pull back off that 200-day moving average, behaving much weaker than what we've seen in the S&P 500. So other things that we care about from an equity perspective, certainly we had a spike in volatility as the market was correcting. Sort of the NASDAQ was down about 18, 19% off the highs. When we retested the lows, volatility did not spike. It's been moving lower and in fact closed below this range today which again opens up probably moving down towards 20 or down towards 150-day moving average. The fact that volatility is dissipating, or the market participants' expectations for volatility is dissipating, it's setting up a more constructive environment, certainly going forward for stocks. When we look at the various groups and sectors and themes, there is huge disparity between what's working and what isn't. The sort of private investor retail favorite innovation companies, as referenced by the ARK Innovation ETF, Kathy Wood's main ETF, through the course of the correction was down 59% from February until the Nasdaq finally cracked in the early part of 2022. It's had a little bit of a bounce, really nothing on a relative basis. In fact, not all that far from the lows. So that doesn't really inspire confidence to us. It tells us what's going on in unprofitable tech is less attractive. Our view has been that long duration or high multiple growth stocks are very unattractive in a world where rates are rising, and the market seems to agree with us. So those companies that were favorites in January, February of last year really have come down significantly relative to what's happened in the S&P 500. And within the S&P 500, some of those big tech darlings have also come off the boil, and certainly less in demand as it is currently, and owned by everyone. So once they come off the boil, they can underperform for a period of time. We're going to have to see what happens going forward. Let's look a little bit at some of the data through the course of the week. Certainly, COVID cases are coming down, and the move towards removing COVID restrictions is real. The number of states with active COVID-19 emergency orders really is coming off. The percent of US adults who think it's time to accept that COVID is more endemic than pandemic really has been moving up. And so this means that the world is looking toward reopening, and that has implications for certain sectors. We're in the middle of earnings season right now. Earnings have been coming in strong as expected. Sales growth across roughly 280 of the S&P 500, which have reported. Sales growth is coming in at about 16%, and earnings growth about 27%. We talked over the last couple of weeks how skewed that might be. For instance, energy sales growth is up 90%, and actually earnings growth is off the charts because it's coming from a negative, but very substantial gains in profitability and cash flow. Materials revenues up 30%. Earnings are up 78% so far versus last year, and industrials 12% sales gains, 124% increase in earnings. So there are certain sectors that really are benefiting. We call those shorter duration groups where price can change for their products very quickly, products that get used up and repurchased frequently, where inflation can be priced in rapidly, as opposed to, say, a company that sells things on a long-term contract, like, say, a real estate investment trust, renting real estate for 5 or 10 years at a time at a fixed rate. If we look at the sales surprises, the average company beaten the sales number by about 2.5%, and earnings beaten by about 9%. Most importantly, analyst expectations for earnings going forward continue to rise. Now, I know that there is a cadre within the market who feel that growth is peaking. That may be the case, I suppose. It is not showing up in the numbers. And when we look at the sectors that are leading, they don't tend to be the sectors that would start to lag. In fact, they're behaving quite well, and we'll talk a little bit about that as we go. Our basic belief is that in a healthy market over time, a higher and higher percent of securities should be participating in a rally. So often the leaders turn higher first while the rest of the market is correcting. And then as you go through a rally, the breadth of the advance should expand, which means money's getting put to work in a number of different areas. Ultimately, buyers probably get a little over exuberant and wind up being willing to buy almost anything. And around that time, the weaklings or the weakest securities will start to sell off underneath the surface. And if enough securities start to break down in price, it'll impact the indices and we go the other way. I bring that up because there are some very specific sectors that buck the trend through the course of the correction, and they have continued on to perform well, while some of the lagging sectors are acting a little bit better. What we see in our breadth models is in the NYSE, we're seeing expanding breadth, meaning the percent of stocks in uptrends is expanding. There's no bear market in history ever took place while breadth was expanding. That is when we are most comfortable being invested. We're not to the point where a very high percentage of stocks are in uptrends. We're sitting now right down around 40%. Canada's about the same. And when we look around the world at the shorter term indicators, they're improving as well. Percent of stocks trading above the 50-day moving average in Canada moved up this week. It moved up in the US. It moved up globally. The percent of stocks making new highs versus new lows expanded. And the percent of stocks trading above the 150-day moving average or 30-week moving average also moved higher. So virtually all of our breadth indicators moved higher this week, which means the market's health is improving. It makes it easier to be in the right stocks if a higher percentage of them are in uptrends. And we watch very closely because we don't tend to put on new positions when breadth is contracting. We tend to be more defensive. So let's talk about leadership. Our job isn't to be everywhere. Our job is to find those sectors that can generate some excess return beyond what the market is doing, where there is a tailwind, where something structurally is changing for the better, where we can not only get paid for earnings growth, but where we might see some multiple expansion. So we're always focused on trying to say, are the groups that we're focused on leading within the market? And if not, is there new leadership emerging that we should be considering? In the absence of leadership, maybe we should sit on some cash, or maybe we should be on the sidelines and play some defense. Because the most important thing, frankly, is not to lose this little pile that you spent your life accumulating. When the market's good, we want to participate. When it's sloppy, our best job, I think, sometimes is just time to sit on the sidelines. So we are quite tactical about this. So let's first take a view from an income investor's viewpoint. What's working and what isn't? Well, clearly bonds are not. The aggregate bond index, as I said, in the US down about 4.3%. That's a really tough start to the year for bonds. In fact, if we look at high yield bonds, they had one of the worst months on record going back over the last 20 years, a particularly difficult month. Investors are moving their money out of some buckets of fixed income. Part of it would be because higher rates mean bonds go down. Part of it might be that they have concerns about various parts of fixed income market, but there is a mountain of money that has been pushed into bonds over the last 30 or 40 years of falling interest rates, where you consistently made your interest payment, your coupon payment, but you also got some capital appreciation as rates went lower. Well, now going the other way, yes, you get your coupon, which today is as small as it's been in a few hundred years, but at the same time, you're losing capital as bond prices fall. So it doesn't really matter where. This is a basket of international sovereign issuers, so government bonds. The ETF fell this past month from $57 to $53, down 6.9%. That's a tough month. The problem is most bond investors are fairly risk averse. So they start losing money at this rate. They start pulling money from the asset class. Now, if you're an income investor, it's probably got to go somewhere. So where else is it going to go? Well, it's not going into preferred shares. Preferred shares had, again, one of their worst months. Things generally tend to weaken over a period of time, and then the wheels start coming off the bus. This is not a place to be focused on generating income currently. High dividend paying common stocks. We talked about this. This is a basket of global high dividend paying stocks. They don't tend to be very economically sensitive. They're pretty predictable, but in a world of rising rates, less attractive. Where we are seeing money move is towards dividend growth stocks, and that continues. Relative strength versus the S&P is improving. So these are arguably more cautious or conservative stocks than the average, because these are companies with a long history of dividend growth, and we are getting yield support from that. But they not only are getting that yield support, but the share prices are outperforming the S&P. This is kind of like getting a free lunch, a little bit better return with a little bit less risk. This has been a core focus for us. And we got our first lift from October of 2020 through the spring of this year. Then they consolidated, but we got paid our dividends. And now they're showing acceleration versus the market for the next leg higher. So dividend payers relative to non-dividend payers, we put this up last week, really have been benefiting over the last few months. And this looks like a regime change to me. Other areas within dividend payers that have been particularly fruitful, we talked about this over the last few weeks. This is an ETF made up of upstream commodity producers. So I use this as an example. We own rifle shot individual positions within this sector, but this ETF has a yield of 3.3%. It's had very good dividend growth over time. It's making new absolute highs today and new relative highs versus the S&P. Some areas within this that we think look attractive. Labrador Iron Ore is one of our bigger income investments. It gets paid, it pays out a dividend based on royalties that they receive from the Iron Ore Company of Canada. The more iron ore that gets shipped, the more royalties that they get paid. As prices move higher for iron ore, they benefit. So this is a way that we can get a nice yield with some inflation protection. Rio Tinto is another, one of the biggest mining companies in the world. It's got a market cap of $124 billion. Yield is over the last 12 months, 8.9%. Yields likely to go higher because the commodity prices are working their way higher, and we're getting strong relative price appreciation versus the S&P. So lots of places that we can go. Newmont Mining, gold sector has been stronger over the last few months. These really kind of bottomed out in September, moving up relative to the S&P since then. 3.5% dividend, again, benefits as the price of gold goes higher. Financials, big beneficiary of rising rates. You can see this is an ETF made up of some of the largest US banks. Yield is a 2% yield, dividend growth rate in the teens, a lot more attractive than a fixed income yield coming from a basket of, say, US government treasury bonds. There's Morgan Stanley as a rifle shot position in this theme, 2.6% yield. And of course, we know that the Fed has given the large banks the right to start raising their dividends. You've seen a nice pickup in relative strength versus the market, and they're benefiting from a lot of money pouring into Morgan Stanley's asset management business. In fact, yesterday, there were over 30 companies in the financial sector that made new relative highs versus the S&P. So this group as a whole is being revalued versus the rest of the market. And this has been one of the biggest weightings that we've had in portfolios over time. Here's Canadian banks, not much different. Strong relative price performance versus the market, good dividend growth. The global bank index is the same. The global bank index is making a relative breakout versus the MSCI, relative to the S&P 500. Big pickup in relative price strength. Again, dividends plus dividend growth plus multiple expansion. We spent last week talking about the fact that there are dividend growth companies across almost all sectors. And this is where we're seeing some of the best performance that we're seeing across the firm in energy, financials, and materials, which have been key themes. But of course, beyond there's also been strength in other sectors. So let's jump ahead. Across rest of the group in financials, insurance companies continue to relatively outperform. Consumer loans have been strong in the regional banks. We're getting relative appreciation there versus the S&P since September. In insurance, one of our bigger positions, IAG, this company works across all kinds of different financial services, but largely in the insurance space. 2.3% dividend, likely to grow north of 10% a year. Let's move on. Energy. Energy continues to perform well. This is Brent oil. Again, strong relative price appreciation versus the S&P. This is important because energy was a very, very weak performer until about 18 months ago. The Canadian energy producers have been very, very strong. They're off a little bit today, but have been moving up smartly, both in price and relative to the market. This is the XLE, which is the largest oil companies in the US. This pays a 3.4% dividend. Dividend's been growing at about 10%, and you've seen relative appreciation since the beginning of this reflation rally. We just made a relative new high versus the market. And when that happens, when you get this kind of thrust, it tends to be earlier in a bull market than later. So if you look at energy sector performance versus the S&P 500 since 2008, it was a long period of underperformance. We went through that inflection point in 2020. And the fact that we've had a good 18 months really doesn't mean much when you consider that it really has only moved up on a relative basis versus the S&P over the last 18 months. It could potentially have a long way to go. When we look at energy versus the S&P over a very long period of time, it made a relative low versus the S&P in the late 1920s, and then went on to outperform for 30 years. And it had a bear market in the early 1960s, went on to outperform for the next 18 years. Outperformed from 1998 until 2014, bear market. Again, this is something that may just be beginning and could go on for some time. We also have highlighted that as a whole, commodities may have begun a relative bull market versus stocks. So commodities might be an important way to hedge against inflation. So is that continuing? Well, this is that RJI basket. You could see relative strength versus the S&P fell all the way through from 2008 until 2020, where relative performance reversed and showing no sign of abating. This is the daily chart over the last few months, just slowly ticking its way higher. So this is a bucket within our portfolios that has been relatively and steadily growing versus some other sectors. Copper versus the Nasdaq, certainly we had a bear market that went on from 2014 through 2020, 6 years, broke out, consolidated, and has started its next leg higher. And within there, we see a number of companies. Freeport-McMoRan, Teck Resources are favorites of ours. This is an iron ore producer, Rio Tinto. Rio Tinto, as I said earlier, paid over an 8% dividend over the last 12 months, likely to be higher going forward. We're getting a dividend plus nice capital appreciation versus the market. There's Teck Resources today actually made a new all-time high and a new relative high versus the market. Agricultural commodities continue that vein. This is the DBA ETF, which is made up of agricultural companies. A long period of underperformance followed by bottoming, and now relative outperformance versus the S&P, again making a new multi-year high today and a new relative high. Corn has been particularly strong. Soybeans have been particularly strong. And with those prices going higher with inflation, the companies that produce seeds and the companies that produce fertilizer have pricing power. There's Nutrien, one of our big Canadian agricultural companies, a 2.5% dividend yield and price appreciation. And CF Industries, which is one of the largest producers of fertilizers, including urea and ammonia nitrate and ammonium nitrate. Forest products continue to perform well, moving higher since the end of October. Note that none of these industries are sexy. None of these industries really are being discussed very much on CNBC and BNN, but certainly they have been great return generators, and we think that they are uncrowded and likely will attract investors going forward. There's Weyerhaeuser, which used to be a lumber company that traded like a corporation. It's now a REIT that it controls 14 million acres of long-term timberlands in the US, and again pays a dividend that is likely to grow as we move along, and we're getting relative performance versus the S&P. Consumer staples, another group that have been able to raise price as their underlying costs have been going up. Consumers seem to be getting used to the fact that prices are going higher. We all pay them in the grocery store. We might as well own the companies that are producing the products. Again, strong relative price performance continuing. Some of the retailers within the discount area, like Costco and Dollarama, really benefiting from an expansion in their revenues as their prices go higher and their margins are expanding. On the reopening theme, travel and leisure starting to see a bid. And this has been another area that we've started to add some exposure to. I think most of you know we've had McDonald's in the portfolio for quite some time, but this is a group that is attractive. We're seeing some improvement in some of the aerospace companies, but reopening relative to a basket of reopening companies relative to the S&P is performing well, and we're trying to focus in those areas. Last couple of groups, one group that did certainly correct well was the semiconductors. Within technology, it's one of the most economically sensitive groups, but in the end, it wasn't strong enough to fight off a cross technology sector correction. But this is the one group that quickly has come back above the 200-day moving average. Qualcomm would be one of our bigger positions, actually very close to the highs, trading better than 93% of companies in the S&P 500 over the last 12 months. As a theme, value continues to perform. So we know that technology was particularly expensive when we look at price earnings multiples. We know that value on a relative basis had a great run from October of 2019 through until 2020 through until spring of this year. I think lots of people got frustrated because they did go into a consolidation period, but we certainly have started the next leg higher for value as a whole. This matters because correlations stock to stock within the S&P continue to be very low. That means the market is sorting the good from the bad. There certainly are groups that are having difficulty, but there are groups that are really outperforming. And by targeting, we can make a big difference in the portfolios. We think in general, value is underowned. There's lots of low-priced companies trading at very low multiples in sectors that have not been sexy, that are benefiting from price increases, are benefiting from margin expansion, and are benefiting now as analysts are slowly starting to ratchet their earnings estimates higher. The differential in January between the good sectors and the bad sectors was as wide a margin as we've seen in a long time. And that could be important going forward because that often happens at regime changes. From a sector weight perspective across the firm, our financials weight continues to be the largest. It expanded a little bit this week. You'll note that last week we had pretty good sized cash weight coming out of that correction. We started putting money back to work. Short-term bonds as a placeholder or as a cash alternative has come down about 10% over the course of the week, and the cash position also came down to about 3%. We expanded our weight in financials because they held up better through the decline and they started to rally right away when the market started to firm. We think there's good risk reward in the dividend growth, and they are beneficiaries of reflation. Energy has become an even larger portion of the portfolio, combination of producers and service companies, companies in the area of production, also some natural gas related companies, some oil related companies. Materials also continue to grow in the portfolio, and in materials would include, the agriculture companies, the forest companies, some of the metals producers, and some of the precious metals companies. Technology continues to be a very lightweight in the portfolio. They really haven't distinguished themselves off the bottom. There are some specific companies that are doing better than the rest. In general, the dividend paying large cap technology stocks have behaved much better than the Nasdaq. We do have some exposure there, but it is, as you can see, about a third of the weight within the S&P. Real estate investment trusts have come up a little bit in the portfolio. Consumer staples are about still market weight. Communication, utilities, consumer discretionary, healthcare, and industrials remain underweights within the portfolio. We'll continue to evaluate that. Outside of the equity portfolios and the income portfolios, our macro portfolio has been making some changes. We've been upping the weight that we have in global stocks. The US market has outperformed for a long time. There are some areas of the global market that are starting to outperform the US. One notable area is after, well, 30 years of underperformance, the Japanese stock market has behaving a lot better. It tends to be because there's a lot of banks in the Japanese market. The Japanese bank index has made a really good turn off the lows and is making new relative highs for the first time in about 2.5 years. But frankly, Japanese market also is a value-driven market. 43% of the companies in the Japanese market trade at a price earnings multiple of less than 15 times, and has 30% more companies trading with a less than 10 times multiple compared to the S&P 500. So if people like value, the Japanese market is one that they might tend to take a look at. Also, outside of the US, other areas of Asia behaving well. Indonesia has, again, a large bank weighting within the portfolio or within the index. Is behaving well on a relative basis. The UK has lots of value-related companies. It's having quite good outperformance and is based out much like the US market did from April until November, and it's starting to improve as well. And then high dividend paying stocks or dividend growth stocks, in emerging markets have really made a nice turn, and they're looking more interesting. So from a diversification standpoint, some of our equity weight has been taken outside of the US. So just before I came in, I took this clip. In our macro portfolio, the S&P was up a little today, not a lot. The miners ETF was up 3.8%. Semiconductors were up 3.1%. Large bank index up 2.6%. Regional banks up 2.59%. Copper producers up 2%. Steel producers up 2%. Travel and leisure up 2%. Forest up almost 2%. We can go down the list. This is insurance up 1.4%. European financials up 1.6%. Dividend growth ETF up 1.45%, almost 1% better than the S&P. Transports are up 1.4%. On the other side, things not working. The various ETFs that are invested in government bonds and high yield bonds. This is the high yield bond ETF down 0.06. Mortgage-backed securities down 0.23. These are all short positions in the macro portfolio. And so when we look at the macro exposures, it's financials, precious metals, energy, commodities, Canada, dividend growth. It's about 11% of the portfolio. Materials is 9%. Reflation versus short disinflationary positions. And it seems these positions are working out. I'll leave you with this. We've made the case now for the last 2 years that we were headed into a regime change. And our view was that we were probably early and it would take lots of people time to figure this out. This came from one of the top macro research firms in New York today. They're making a case today that we may be seeing a regime change. So the points that they make: for the first time in QE era, bond yields are up during a market correction in January. In other words, they didn't act as bonds didn't act as support. In fact, a 60-40 portfolio, equity and bonds, had its worst 1 month in 20 years. For the first time since QE began, the energy sector outperformed during a market correction. Energy sector was up during the period where market was down. Typically, energy was seen as just a high volatility area of the market that would go in the direction of the market. That was not the case. So that means money was rotating into energy as it was coming out of tech. The QQQ, or the large cap tech ETF, did not act defensively because it had predictable growth stocks in it. In fact, it underperformed. It was down 18% over the course of that correction. Value growth, rate of change, in other words, the differential between value stocks and growth stocks was the most significant differential since 2001. European and German yields were breaking out above 0%. The European and Japanese banks, after many years of underperformance, are breaking out to the upside. The dollar was not acting in a defensive way. and stocks are beginning to underperform commodities. When I see commentary like this, after not seeing it for a long time, it's not the end of something. It's other people starting to believe that this is the direction that we may be going, and it will take a long time for investors to reposition their portfolios. We're prepared to get defensive if this stuff stops working. We showed that we get a little defensive in January. We did get stopped out of some positions, but certainly as breadth models have turned back higher, we're actually repositioning that money now. And it looks as though conditions are pretty good, certainly for the themes that we're focused in over the foreseeable future. So we'll continue to update as is required. But Pam, if there's any questions, certainly we can jump on them.
Yes, thanks so much, David. Great overview this afternoon. First question, given all the fear in the market about the US Fed having to aggressively increase interest rates, do you think if the Fed announces a rate hike of only 25 beeps in March, that could spark a relief rally?
Yeah, I think that that's very true. And frankly, I'm just trying to see if I can pull up a chart that Diana put up this morning in our morning meeting. So this is a chart that looks at market expectations and positioning. And as it stands right now, because the market has been repositioning for a Fed rate hike cycle, you can see that it has become just about as hawkishly positioned as we've seen in some time. And this chart goes back to 2013. So yeah, I do think that if the Fed were to come at 25 basis points, I don't think they're coming at 50. Market rate expectation right now is a bit split. I think the expectation is about 35 basis points. I think part of what the Fed was trying to do last week was to jawbone the market down, to jawbone bond yields up, to let the market do the work for it without having to change the policy rate dramatically. So if it's anything less than 50 basis points, they've been telegraphing a rate hike. I don't think it's going to be any surprise to the market. The market will get more certainty, and that would be bullish. The market hates uncertainty.
Dave, next question here. Actually, two people were asking why the underweight in industrials.
Well, we're seeing some improvement there. We're seeing some improvement in transport. So this is the transport index. Let's see if I can look at another way from a relative standpoint. Yeah, so we're seeing a little improvement in the relative performance here. That's something that's important. We do have some industrials weight in specific names, like we do have some exposure in the aerospace and defense contractors area. So General Dynamics actually is very close to making relative strength new high, and is trading quite well. It's got a 2.2% yield. But there's a lot of companies that have not been behaving as well. Certainly, we broke below the 200-day moving average. The industrials rallied up underneath it, have failed to push through. This is the industrials ETF XLI. Relative price performance, has been a bit weak over the last few weeks. So we want to see this group show some expansion in breadth. We want to get back above the 200-day moving average. Like to see a few more companies start to participate before we start adding much more weight there. There's lots of other things to do right now. That's the issue.
Right. Dave, final question for this afternoon. Do you tighten up, or does Barometer tighten up its stop losses in positions when geopolitical risk increases?
We tighten up stop losses when the market shows us that it is concerned. If we tried to tighten up the stop losses every time the news got negative, we'd miss all the rallies, because rallies happen against the backdrop of a wall of worry. So there's always things to worry about. I mean, if for instance, when Donald Trump was about to get elected, they said if Donald Trump gets elected, the market's going to go down 20%. The market was up huge the first day, but the breadth models were improving going into it. In fact, the market had started to outperform a month before he got elected. If you had said, well, we better sell stuff because there's going to be tariffs. When the tariffs got announced, stock market went up. So there's always geopolitical risk. The question is, are there enough positive shock absorbers in the system to offset those negatives? So if you think about it, the market is impacted by 1,000 moving parts, and some of them are really obvious that you read about in the newspaper. But on the other side, there are things people aren't thinking about. So for those that have followed energy over the last few years, they said, well, if the market goes down, energy will get creamed. But we saw really good expanding breadth for the last number of months. And in fact, it's a sector that also, though, benefits from inflation. So the time when we tighten stops is when either our market risk models turn negative. That means we should have less tolerance for risk. Or when our sector work turns negative. And in that sector, we then have less tolerance for risk on those companies. I think that it's important to have the aggregate of all of the impacts being taken into account, which the market does and breadth measures well.
Thank you so much, David. That concludes the questions we've received this afternoon. And as always, if you have questions that we haven't addressed on today's webcast, we'd be pleased to do so offline. And with that, David, I leave you with the final word.
Well, look, thanks everyone for tuning in today. I know sometimes it is a little scary when you read the news. Certainly right now, there is a lot of chatter about what it means to see higher rates. But think about it, we've been talking about this now for 18 months and positioning for it. So I would be worried if we had a portfolio full of bonds and stuff that does well when bonds do well. And that would be scary. But as it stands right now, our job is to get positioned and then let other people come in behind us and support our view. And as it stands right now, it looks like that's the case. So thanks for tuning in. And if anything should change, I do post things pretty regularly on Twitter. So certainly don't hesitate to follow at Barometer CA. And we'll continue to do these webcasts and answer your questions. If there's something we didn't answer today, don't hesitate to give us a call. If you think you'd like to have a conversation about either what we're doing now in your portfolios or what we could do, again, we'd love to talk to you. So thanks very much for tuning in.